Okay, well, welcome back everybody to today's Market Explain. This is the show where we discuss the economy, the markets, and how it affects us and what we see out there. That's interesting, we think, for our investors. It's a great way, a great tool for communication with all of the investors that we work with. And I'm Brian Castle, your host. I have Mr. Chris Reardon, my co-host. Chris, welcome to the podcast.
Thank you, Brian. Good afternoon, everyone. Glad to be here. Glad to talk a little bit about these crazy markets and what's going on.
Well, and everybody knows from in the previous episodes, Chris is the director of development for FourStar, anything portfolio development and products to help out investors. He's got a young family with 3 kids under 5 years old still. It's unbelievable. But anyway, good stuff, Chris. Welcome to the podcast.
Thanks, Brian.
And I'm Brian Castle, your host. I'm the CEO and founder of FourStar Wealth Advisors, Chief Investment Officer. I'm also a trustee of the National Boy Scout Foundation, or Scouting America, we call it now. And I'm husband to the amazing Tripty and father to 2 adult males, Evan and Quinn. And we're ready to go for the podcast today. Chris, tell us what is happening in the relative discussion. Now, we've had a big change in the markets. We had a big change and a big change back because of the war, 3 weeks now of war. What does it look like now, Chris?
Yeah, so it's really interesting because if you're, the way we usually report on this is obviously snapshot to snapshot. So from the last podcast to this podcast, there's been no change. If you just kind of look at a picture to picture, no change in the asset classes. But kind of in the middle, we saw commodities rocket all the way up and then collapse all the way back down to its original position. So in between the podcast, there's been a lot of movement, but from podcast to podcast is what I'll kind of report today. International equities is still the number one position. It's at 277 tally points, and it's minus 15 from the last podcast. Domestic equities is still holding in at that number two position. It's at 269 tally points, and it's minus 3 since the last podcast. Commodities is in the third position. It's at 227 tally points, and it's funny enough, minus 29 tally points since the last podcast. So, it's really pulled back significantly in that short period of time. Cash is in the fourth position. It's at 125, and that's plus 15 since the last podcast. Currencies is in fifth, and that's at 102. That's plus 16 since the last podcast. And fixed income is still in last at 85, but it's plus 15 as well since the last podcast. So, the trend clearly is more of a risk-off environment as far as what we're seeing here. You had the bottom, the less risky asset classes, cash, currencies, fixed income, gaining this past week. But I think it's important to highlight domestic equities only lost 3 points, kind of podcast to podcast. So, that one wasn't, we didn't see a major deterioration there. I think the interesting thing to note is, at least looking at it year to date, we saw a spike in volatility that I think would have seen maybe cash or currencies move up more than they had. But we had such a tremendous move in commodities with oil prices and everything. And previous to that, precious metals, that commodities kind of sucked the air out of everything just with its quick move. And then the pullback after that is the breath was released. And now we're seeing those defensive asset classes, which probably should have been picking up more tally points than they were, but they were just kind of getting beaten out by commodities with that quick move, are starting to kind of re-normalize to probably where they would have been. So really interesting, I think, as far as what the asset classes and what we're seeing right now.
Brian Castle. I'm the CEO and founder of FourStar Wealth Advisors. Now, we built FourStar on one simple belief that every client deserves clarity, confidence, and strategy built around their financial story. For over 40 years, we've guided clients through every market cycle, helping business owners, families, retirees protect what they built and then grow their holdings to meet the needs over their entire life for them and their family in the future. We are fiduciaries, not salespeople, and that means we sit on the same side of the table as you always. So from personalized portfolios to advanced tax and estate strategies. Everything we do is about creating long-term freedom and peace of mind for our investing families. So if you're ready to align your wealth with your goals, visit fourstarwealth.com. Let's start building your future one smart decision at a time. So Chris, the commodities went all the way up from third to first and came all the way back down to
Yep.
third
I think
in 3
go-
weeks.
it touched, I want to say the last podcast, commodities were at about 256 level wise. It touched, I believe, like 285, mid 280s, before pulling back all the way to 227, was the most recent reading. So you can see that drastic move we saw. And a lot of that, as you would imagine, was due to the Iran conflict, what's going on there, obviously the impact on oil prices. But not only that, I mean, food prices, everything, since oil is kind of the lifeblood of the economies as they run right now, trucks, things like that, diesel, it directly impacts everything. So we've seen that really play out, and we've seen this cycle up and cycle down pretty quickly.
Well, we saw precious metals run up on a very, very high spike move, and then precious metals collapse. Now, what do you think caused that, Chris?
Yeah, there's a couple things. I think you definitely have some people taking gains, but you also have, with this volatility, you have some people who own precious metals who maybe had margin calls, things like that. There's also been speculation in the Middle East that you have some of those countries selling their gold reserves that they were buying to pay for defense spending, things like that. So I think um, it's kind of a global, I don't say, a pullback a little bit, where you just have people kind of taking some of those gains that, they loaded up on it, as you said, Brian, and it had such a strong year. I think you have some people just selling those assets. It is important to note, I believe it's still flat year to date overall, but it has pulled back significantly from its high towards the end of January. But I think that's somewhat natural within that. I mean, we had such a tremendous run in gold. This is typically a period where you would see gold being one of the major benefactors, and it hasn't been. Usually when you have volatility, you have Iran conflict going on right now, Iran war, whatever you want to call it. Usually gold is one of the primary safe havens, and it hasn't been. But it doesn't mean it's not going to be, or it's completely deviated moving forward. It's just, I think we've seen the last couple months, we've just seen a lot of people selling those, maybe raising cash. A lot of major powers, sovereign governments that have gold reserves that have been loading up on that, offloading some of those assets for cash or to buy defense assets, things like that.
Well, I do remember in previous markets, especially in the 2008 market, when everyone was heavily levered, people were selling things to pay off debt. The markets are going down, and people got caught with too much margin, and so it was we say it's a sell them if you got them market. And anything they had that was good was for sale, and gold and precious metals were up and really big and really good, and they're the best investment they had, so they started selling that instead of the stocks that they had margined or something like that. So it seems like that happened also in the tech crash. It happened in 2008. It happened again here. So even though gold wasn't the problem, gold became something to sell to pay for everything else.
Yep, exactly. Yeah, I think that's one of the primary drivers. But like I said, I think, we'll talk about this a little bit later, but I do think that there's still the case to be made for gold. I just think it's entered a little bit of volatility in the short term right now.
Yeah, and the question is, now people are reaching out saying, "Oh my God, what do we do with our gold? Because it's down 10 or 15%, silver a little bit more from the high." But anytime an asset moves as fast as gold did, it was up 100% in a year. Could you see a retracement of maybe a quarter of that? Oh, absolutely, right. But when that happens, everyone gets really nervous and freaks out, and they forget the big move. All they see is the last move down, and they get nervous, and that exacerbates those moves. And that's how this thing moved so quickly up and then so quickly down as everyone piled in. And all the surveys have shown that individual investors tend to buy at the top and sell at the bottom, or they sell in panic moves, and that's really a shame. So we have a protection plan that helps avoid that. We'll talk a lot about that a little bit later because we're in protection mode now. But just watching the move in gold and precious metals, just kind of illustrates how human emotion can really cause lots of trouble for you if you don't have some way to check it when you're in the financial markets.
Yeah,
So,
100%. I mean,
yeah.
and 100% that it's healthy within a market like that that made such a drastic move. In some cases, it's actually, I would say, could argue, good for that market because you're getting some of that air out, you're getting some of those sellers out, and then you're going to see where that support line is, and it will find support. When it does, it'll probably, base support and kind of start to move back up from there again. Is
Well,
usually.
and Chris, we saw this play out also in the technology stocks, where on the last year, previous year, the technology stocks, the Mag 7, they were calling it, were running. The AI stocks, they were up, 100, 200% in a year with outrageous multiples. And then starting about last fall, they started to sell off. Very difficult for most of this first quarter. First quarter is ending in about a week. But now that the other parts of the market are selling off due to the war, the technology stocks have been acting a little bit better because they've already corrected really hard. And about a month ago, and not gold or silver, but people were saying, "Oh my goodness, what do I do with my technology stocks now? They're getting crushed." And that's what happened again there. So anytime there's an outsized move like that, to expect a sharp reaction is natural and normal, and people should expect that. But again, when we go through it, nobody acts like they expected it. They all get nervous and they do crazy things and they sell into it. And so we do pair positions during periods of time like that, just to manage risk. But that's taking profits, right? Because it's been such a good thing. But then we might be ready to get back in and increase our position if things stabilize and start to run up again a little bit more, depending on the position. So that's where we stand on that. But Chris, what else do we see?
Yeah, so flipping over to the sectors, kind of where we stand year to date, we still have energy leading the way, and it's by far the leader. It's been the best performer, bar none. It's up 37.13% year to date. So continues to be the biggest performer. The second best, and actually moved up 2 spots, is consumer staples. It's up 5.78%. So you can see that wide gap there between the number one and number two. It's a pretty substantial gap. Number three is utilities. That moved up 2 spaces as well, or 2 spots. It's up 5.75%, so just a hair behind consumer staples. Industrials moved down 1 point, and it's at 5.42%. Materials moved down 3, so it was kind of the worst one, if you will, as far as losing position. It's in fifth position now, and it's up 4.18%. And then rounding out kind of that top half is real estate, and it was flat. It's up 0% actually year to date after pulling back.
Mhm.
Bottom performing sectors. So seventh is communications, and that's down 5.75%. Uh, information technology is down 5.85%, and that actually moved up 1 spot slightly. Healthcare dropped 1 spot, so they kind of swapped, and that's down 7.20% year to date. Consumer discretionary is down 8.30 and a tenth, and then last is still, it started there and it's still there's financials, and that's down 9.99% year to date. So, the biggest rotation we've seen so far this year is obviously a rotation to defense assets. You have energy, which is kind of its own world, but outside of that, consumer staples, utilities, even industrials, materials, you could argue real estate. These are more defensive kind of asset plays.
Mhm.
Specifically, staples and utilities are kind of classic defensive plays, where you're looking at the Walmarts, maybe these where people go to buy groceries, things like that, the necessities, and they're looking for higher yields there as well. So
Mhm.
we're really seeing that more of a risk off environment so far, in 2026. Doesn't mean it's going to change or it'll end that way, but certainly we've seen the risk off sectors have had a better year so far.
Yeah, so energy is running because of the war, but then consumer staples and utilities are usually two sectors that run positively in a bad economy, bad market. Although last year utilities were running because of energy and AI, but now we're seeing a reaction to just potential recession. People buy stable things like utilities and consumer staples, which is food stocks and things like that. Materials going down, that's the precious metals and things like that. Although ironically, of the bottom performing sectors, Chris, you mentioned the one that was moving up is information technology. I mentioned that the very, very sharp reaction to the Mag 7 and technology names started last fall and kind of ended relatively about like 3 weeks ago, right as this war was beginning. So that actually is up, even though it's down for the year. It's up from the previous podcast, but quite a wide, Chris, difference between the sectors. Energy up 37%, and the worst is financials down basically 10%.
Yeah.
47% difference, and that, ladies and gentlemen, makes our average, the S&P 500. So we'll get to the averages in a minute.
Yep. Yeah. So, I mean, yeah, it's just a huge gap there. I mean, you could even say the gap between the 1 and 2 is pretty significant as well. It's pretty huge. But switching over to kind of current market themes, so we continue to see more of a broadening in the financial markets. The S&P 500 equal weight is up a hair under 1%, 0.96%, whereas the S&P 500 itself is down 3.66%. That's more market cap weighted, so you get a much heavier weighting towards the Nvidias, those Mag 7s that we were talking about. So we continue to see a broader market that's doing a little bit better. International continues to lead US slightly, but it has had a major pullback. At one point, emerging markets were up 15.78. Now they're only up 3.67%. So we've certainly seen a bit of a pullback there. Developed international markets are just under 0%, so they're down 0.40%. We continue to see value outperforming. That's what we would expect. So value is usually with those defensive stocks. That's usually kind of they're characterized. So value stocks are up 2.51% year to date. Growth stocks are down 8.54%. And then, I think most interesting of all, we've seen smaller cap companies outperforming larger caps. So as you scale down, small caps are still up 1.24%, whereas mega caps are down 4.78% year to date. Large caps are down 4.08%, and mid caps are down 0.65%. So as you scale it, the small caps have benefited, which is typically not what you see. Usually the mega caps, because those are those Walmarts, those are these giant companies, these big stocks, these value stocks. Usually those tend to outperform, but with tech and with everything, with the Mag 7s, with all these, we've kind of seen that be flipped a little bit. And then obviously with the tariffs, kind of the deglobalization a little bit, that trend, I think the small caps have benefited a little bit more as of late.
It's interesting, the numbers you said, Chris. So, folks, when you watch CNBC or you watch Fox Business and they say the S&P is whatever it is, that's the one that's down 3.66. That's the main S&P. But the S&P equal weight, which is really the average of all the value of the performance of all the stocks, is actually still up for the year. So it feels like there's been lots of damage in the market. And we were up about 10% for the year. Now we're down. We've seen a sharp move down, but more stocks are up than down. And the interesting thing is the mid caps are flat on the year and the small caps are up on the year as well as the average stock in the S&P. So it's not as bad as folks might think, but yet all the headlines go to oil. All the headlines, which is up. All the headlines go to gold, and all the headlines go to those big tech stocks that were down big. But the damage hasn't been as bad as you might think, Chris, or others might think. So let's take this in a more measured way. Let's hope it doesn't get much worse than this. But could this kind of move cause a recession? We don't know. But there's still a good chance that if they solve this war and the oil prices recede back from 100 back down to about $70 a barrel, there will be a very short-lived thing and it won't be a recession. But it's all a matter of how long this conflict goes on in the Middle East.
Yeah, I mean, I think that we don't know if it'll cause a recession or not. I do think that with what's happened as of late, and we'll talk a little bit about that, but there's a lot of production that's been taken offline via, Iran's fired missiles at Qatar, things like that, and hit some large production plants, things like that. So, it's going to be hard to get those back online soon. So I do believe the oil production in the short term has been impacted. A lot of countries are going to try to help alleviate that by releasing their strategic reserves, things like that. So there are things we can do to help buffer that. But these aren't things that they can get back online in a matter of a week or something like that. So it's probably going to have an impact. I think we don't know the significant impact of it. Is it going to be a huge hit? Is it going to be, minor, a couple of GDP points per se? We'll see.
Exactly. All right. So the dominant story about the war is really is on, Chris, right?
Yeah, I mean, I think the biggest thing right now, obviously, is the war. Um, you know, and not only you have Iran, which is obviously a big global oil producer, but the biggest thing, and if you've watched the news, you've seen this, the Strait of Hormuz. That is the world's most critical oil shipping lane, and it's approximately 20% of the overall global oil supply goes through there. So that's why there's been a big fight. There's been a lot of back and forth over making sure it maintains staying open as well as is safe. So that's the biggest thing. I think the key there is oil. It not only impacts, yeah, but obviously we've seen oil prices skyrocket, but it reprices risk across every asset class. So obviously if we have oil prices going up, that's going to impact gas prices, which is going to impact inflation, which is going to potentially impact what the Federal Reserve does. We'll talk about that a little bit next. Which is going to, have impacts to equities and safe haven. So it is a very much trickle down aspect there. So that's why we've seen such volatility based off of this move, because oil is such a vital component to the global economy. And it's literally ingrained in almost everything. Because trucks, you have all that shipping, any of that, jet fuel, ships, everything, they all either run on diesel, jet fuel, any of that stuff. So
Mhm.
we've certainly seen that play, and that's why you are seeing such volatility within the markets. I think to your point, Brian, and we saw a little bit yesterday, if we do get a quicker, conclusion to this war, I think we'll get a short-term pop, but we still are going to have to kind of see the damage done, and that's going to take months. We still
Mhm.
haven't even gotten the CPI or inflation reads, with the Iran war kind of baked into it. So
Mhm.
there's still a lot we don't know.
So coming into this war, Chris, we saw President Trump selected as next Fed president, who will come in sometime in April. And of course, the talk was that there's going to be at least two or three interest rate cuts to get the economy going. President Trump was frustrated with his previous Fed chairman, so he's replacing him. He thinks he's going to get some interest rate cuts. Now we're seeing things really slow down because of the increased cost of oil. It's nowhere near as bad as it was right now mathematically as like the 1970s when oil went up sixfold in 2 weeks and totally destroyed the economy for a number of years in the mid 70s for anybody who was around then. But there are some effects to what's going on with this oil war over Iran. And now, it's all kind of in doubt, isn't it, Chris? So where are we on economics, on Federal Reserve and interest rates?
Yeah, so the Federal Reserve met this past week, and they left rates unchanged. So that's at 3.5 to 3.75%. That's a second consecutive meeting. They've kind of left things unchanged, and that followed three consecutive 25 basis point cut meetings to close out 25. So there wasn't really much of a surprise to that. I think everyone pretty much was anticipating them to kind of hold rates steady. I think the key from that meeting is their rate path they kind of project. So they're still signaling one cut in 2026 and one cut in 2027. But I think the markets especially have taken a lot of that with a grain of salt because obviously this war, if we get higher inflation data, it's going to be much harder for them to cut even one rate cut if we're starting to get higher reads of inflation. So
Mhm.
we still have to kind of see. As far as some of the inflation data, the last read we got of the CPI was relatively tepid. Although I will say this was before the Iran war, so that's kind of the caveat with it for that CPI read. But the February read was up 0.3% month over month. That's
Mhm.
up just 0.1% from January, which was up 0.2. The year over year CPI, our consumer price index read, was up 2.4%, and now is unchanged from January. So overall, obviously the CPI inflation numbers looked good. The biggest movements there, shelter costs were up 0.2%, food index was up 0.4%, and energy, and this is before the Iran war, was already up 0.6% in February. So um, that's interesting, but the where people are starting to read a little bit more into it is the PPI. So this is the producer's price index, and a lot of people look at this as kind of a more of a leading indicator, because if the producers are getting more, if their costs are getting higher, then they're going to pass that on to the consumer. So the headline PPI number for February came in at 0.7% month over month, which was
Mhm.
more than double what the estimate was, which was 0.3%. And the headline PPI year over year was up 3.4%. And that's the hottest read we've had since 2025. Um,
Mhm.
I think the service costs and food prices were some of the biggest um, drivers of the increase here. So once again, this is before the Iran war. So the next reads we get will be I think much more telling. So what does this all together kind of read? I think Brian, you touched on, I want to say the last podcast, but the potential for stagflation is where what we don't want, right? And so that's where you have
Right.
a slow growth, stagnating economy and high inflation. So before this, the jobs number was we talked about in the last podcast, but we had a negative 92,000 jobs read in February.
Yes.
You have that plus potentially higher inflation, and that's where you kind of run into this. And that's where it's going to hamper what the Fed can do because they're unable to. If we have a really slowing economy, but we have high inflation, that they can't cut rates because inflation, and it's just going to grind the economy to a halt. So something we don't want to see. We certainly aren't there yet, but it's certainly something that I think with what we're seeing now is a potential out there. So it's something we have to really keep an eye on.
Yes, exactly. Well, okay, so we'll see if interest rates get cut, and what that effect will be, what the effect is of the whole economic environment caused by the war, and where else do we go, Chris?
Yep. So switching international, in Europe, Europe markets have fared for the most part a little bit better, as we kind of talked about. Internationals held up slightly better. Um, they have gotten a little bit hit a little bit harder with this war. Their natural gas prices have nearly doubled following Iran's attack on Qatari gas facilities. So um, there's going to be ripple effects there for sure. But the ECB is in a bit of a different place than the US. They were much closer to their 2% target than the Fed was. So we'll have to kind of watch and see. Obviously, the Federal Reserve itself isn't standing, in a bubble. So we'll have to kind of see what the ECB does and the impact that could have on the US dollar and kind of global trade. I think the bigger player here that we're really looking at that has effects is Asia. So the Asian economies are pretty much have the biggest exposure to a closure, which we've seen for the most part of the Strait of Hormuz. So China, India, Japan, and South Korea account for 75% of the oil exports coming out and 59% of the LNG exports. So they are the biggest buyers. Obviously, Japan is entirely dependent on outside oil, so they have to ship that in. So a lot of people are keeping a close eye on Japan and what that inflation impact is going to be. And then China, as we know, is such a huge economy, and same with India, that there's going to be certainly impacts there that we're going to see. So it'll be interesting. I think it's something we really have to watch. I think both China and India have tried to kind of release some of their short-term buffer reserves. China's in a better place from that perspective, so they can kind of buffer it in the short term a little bit more, where I think India doesn't have as much reserve, so they're going to certainly kind of bear that brunt a little bit sooner. But we'll have to see. This was going to play out in that GDP growth, that production, things like that over the next quarter or two. So we'll see if
Mhm.
that really, cuts that off.
Yes.
So moving on to potentially what we've really been talking about the whole time, commodities. So crude oil, year to date through this was March 13th was the last read I had. It was up 50. West Texas Intermediate crude oil was up 58.3%, which is one of the largest year to date moves in oil market history. Just huge moves there. Pre-war price for Brent crude was at $70 a barrel. We've seen it touch as high as $120 a barrel before some pullbacks and everything, but it's still hovering around that $100 to $110 a barrel. I think this is really the biggest thing we're really seeing. And in the last couple of weeks, I think it went from obviously having the Strait of Hormuz and the disruption of oil exports there to Iran firing missiles at neighboring oil and gas suppliers and disrupting their production. I think it kind of brings a new stage to potentially to this oil, I don't say issue we've had, but position there. And then touching on what we kind of touched on with precious metals. So gold, gold's interesting. So year to date, it's still actually up year to date. It's still up about 3 to 4%. It's just pulled back significantly from its high, which was kind of end of January. It touched $5,595 an ounce. Now it's trading closer to that 4,547 an ounce. But one thing to note, and once again, from a long-term perspective, a lot of analysts and a lot of banks, JP Morgan is one of the most recent ones. In 2026, their gold target is $5,000 to $6,000 an ounce. Deutsche Bank is quoting $6,000 an ounce. So there still is a lot of, they would say, structural drivers, but you have a lot of things at play, I think, with gold that really impacted. And then silver's had a pretty big pullback. It's still up year to date though, 15%, but down significantly after a huge surge there. But what silver has going for it is the industrial demand for silver. 58% of the demand for silver is now for industrial use. So we have solar panels, EVs, these AI data centers, semiconductors, all those need silver. So, there certainly is a case to be made as far as that bullish case for silver. But just like we talked about, when you have a 150% surge in a commodity, there's going to be an air pocket or two. We're going to see something like this. So,
Yeah.
and then the last thing I'll note, I thought this was a really interesting tidbit. So gold's role in central bank reserves. The US dollar's share of global FX reserves has fallen to its lowest level since 1994. It's at approximately 40%. Meanwhile, gold's share of global reserves has risen to its highest level since 1991, and that's at approximately 30%. So we've really seen, especially China, India's been, they've been doing it for a while now, but that have been making a lot of what's called multi-year purchases of gold, selling dollars, buying gold, selling dollar, buying gold. And that's why we've seen gold get pushed so high. There's been a lot of structural buying there, central banks buying, things like that. So it'll be really interesting to see. China's central bank extended their gold purchase for the 15th consecutive month to start this year. So if that continues, and I would imagine it would, because gold has now pulled back, they're probably going to purchase even more. There's a lot of cases to be made as far as the bottom for gold. So
Yeah. Well, Chris,
yeah.
I might point out that Bitcoin, has had a huge correction, and all throughout this gold rally and then collapse, Bitcoin has still just been kind of selling off and stabilizing. So it's like 16 right now. It's 69,000 a unit. Had been 125,000 at one point. I think 23. But that's up from 10 years ago when it was below $1,000 a unit. So it's had a huge, huge run. But unless you got in, a lot higher than 69,000, you're probably still in pretty good shape, right? But throughout all this gold move, people forgot that Bitcoin was moving for a long, long time. And then that stopped moving, started correcting, and then people were starting moving to gold. So we used to say Bitcoin is the new gold. Now gold is the new Bitcoin, if you will. Hard to figure it out, but maybe Bitcoin's an opportunity here. Maybe gold's an opportunity as well. So just these are speculative moves. Commodities tend to have the most speculative moves, Chris, as you know,
Mhm.
because they don't really have any dividends. There's no, there's not much behind it, not like a piece of real estate or some earnings or something like that. It's just your gold's worth what the next guy will pay for it, and same thing with Bitcoin. They're pure commodities, right? Gold has some industrial uses, dental. People have gold fillings, things like that, but for the most part, it's a commodity. And Bitcoin really is just a pure commodity.
Mhm.
So, and then silver, I know, is even more volatile. I'm going to talk a little bit about that one.
Yeah, so yeah, I think silver, as we had mentioned, I think was we've seen a big pullback there, but I think the biggest news, I mean, with silver is the industrial demand, as I mentioned. Silver is in its fifth consecutive year of a structural supply deficit. So there still is a deficit from a supply demand perspective for silver. So there's a lot of as Brian said, the it's what someone's willing to pay for it. But if you have a demand as far as industrial use for it, things like that, there's a lot of people that need it to pay for it. So,
Yeah.
not only you have people buying it as a store of value, as a precious metal, but you also have these, and that's only going to expand because of its intrinsic properties in solar panels, EVs, AI data centers, and semiconductors in general, which has been kind of the major growth in the world economy. Really since the internet, so
Mhm.
we don't see that slowing down anytime soon. So I think the case to be made for silver, certainly there. I think to your point, Brian, the volatility is going to be much more extreme. So yes, you might get 150% surge, but you might get a 75% collapse beyond, pull back from that, and then it might go back up again. So, it's one of those things that there is a lot of volatility with it, that comes with those moves that we're going to see.
Yes. Well, great. So, Chris, this whole thing about the central bank, and what's happening with gold, what do you see there now?
Yeah, so I mean, I think the biggest thing, like we talked about, is obviously central banks, especially global central banks, moving away from the dollar. I think ever since you could even go back to when the US kind of cut off Russia, we saw a lot of countries they cut them off from SWIFT. A lot of countries looked at that and the threat that the US could put on them. And that's why we've seen them we had that BRICS try to come out with their own currency. We've tried to see them kind of move away from that. They haven't been able to quite yet, but there certainly is momentum in that. And
Mhm.
we've certainly seen a lot of countries, once again, as I said, buying gold, selling the US dollar, so kind of loading up on that gold, that store of value. And I think it's especially frustrating for a lot of these countries if you have to be kind of stuck to the US dollar, because especially when we are in a rate lowering environment, the dollar's getting weaker. So they're holding to an asset class that is essentially getting weaker. Um,
Mhm.
so there's a lot of things I think at play there, but I think a lot of it comes with countries that are kind of, let's say, not necessarily fed up, but that are looking at, what the US can do, and don't want to necessarily be tied to the US economy per se, and what the Federal
Mhm.
Reserve is going to do.
It's interesting, Chris. So this kind of takes us back. If I could take a look at history, there's never been a currency that has been lasting as long as the U.S. dollar without major disruption. So every currency in the world, and then part of the reason is there's a tendency of humans to overspend. So every currency eventually blows up. 1994 was the Mexican peso. The euros had lots of issues. with overspending, and they brought other countries into the euro. If you study currencies and you study governments, there's never been a currency, like, as I said, that's gone as long as the US dollar. But we're at risk now with 38, almost 39 trillion worth of debt. And so that's why gold and the gold standard had always been there. But then we went off the gold standard at Bretton Woods, I believe in 1969, New Hampshire. And so ever since we've gone off the gold standard, all of a sudden the debts have gone up. And we had 5 trillion, now we have 39 trillion from year 2000 up until now. So, maybe that's a point that, there has to be some sort of break on government spending. We don't seem to be able to do that right now in America, but I know President Trump is trying some things. I know they're talking about paying some debt down and getting things organized, but gold has an important role if we actually follow a gold standard. They're talking about using Bitcoin and stable coins now as a banking standard. So there's got to be some kind of break on spending of the public fisc, if you will. And until we get that back, America's currency could just blow up as much as any other currency out there. So hopefully they figure that out, Chris.
Yeah, I mean, 100%. I mean, to your point, I mean, America's the superpower. It's the Rome of today, right? It's this just giant global superpower. I think, most likely what'll happen is, we'll see, America kind of pull back a little bit. And I think we've seen it a little bit now, and just not be the maybe as big of a global superpower projecting and going across the world, and kind of the world cop, if you will. I think we're kind of seeing America potentially start to step back away from there. And I think a large potential for that would be if we saw the US dollar move away from reserve status and go to maybe a basket of currencies, which we've talked about, things like that. So we'll see. I do think there are challenges, and I think, like you said, we've had a pretty good run. It gets kind of rough when you get to this point because of overspending, because of kind of the government, all the, everything we built up. There's a lot of pressure put on the government and the dollar, by fact of that.
Well, and our form of government has been the most successful form of government, Chris, in world history. Created more wealth and more prosperity, more opportunity. People all around the world want to come to America, so it's a classic, huge success from our founders and all the leaders since then. Yet, as President Ronald Reagan has said, we're only one generation away from oblivion at any given time. They used to ask questions of some of the original leaders. Ben Franklin was asked, what kind of government do we really have? And he said, we have a republic if you can keep it. And it's really hard to keep a republic. We have a democratic form of government, but it's in a republic form because we elect our representatives, but then there's an electoral college that represents elects our president. So very interesting in the structure. But yeah, we've created more prosperity in the world, and we can keep that going. But there are forces that are always trying to modify, take advantage, and whittle down all the aspects of capitalism, freedom, and the republic government that we have. So as long as we're the beacon of freedom and capitalism, we'll continue to be the strongest. When we get away from that, we will not be. So we have to be very, very careful, and that's why we need good leaders.
Yep.
So, well, great, Chris. So, what do we see out there today? What's interesting in the world besides all this economic stuff?
Yeah. So, sadly, we had probably one of the most famous action actors. He was a huge meme for a while. Chuck Norris passed away, sadly. So, huge loss there. Tesla has released its first semi truck for for truckers to pilot, and the reviews so far have been extremely promising. These are really interesting for those. I would highly encourage anyone who hasn't just to Google Tesla semi truck, because they are very unique looking trucks. They actually feature the driving seat is in the center, so you don't really have a passenger seat and a driver's seat. You just have one seat right in the very center of the truck. Which is really interesting, but it provides a lot less blind spots for these truckers. You don't have to worry about like the right, you're far away from the right side of the truck, so you can't see out of that mirror maybe as much. So, but these have 500 mile range and fast charging. So, That'll be interesting. You might start to see Tesla semi trucks flying by on the highway. And then Amazon finally got its first major box office hit with Project Hail Mary, which just released. It's kind of a space epic, if you will, featuring Ryan Gosling. And it grossed an estimated 80.5 million in the first weekend at the US and Canadian box office. So
Hmm?
finally, Amazon hit a home run, if you will, with the film industry after trying for so long to break into it.
Yeah. So good for them. So things are changing, and we have Netflix and other companies that weren't even in the film business years ago, and then now they're in it. And so it's
Yep.
all very interesting. The major studio model isn't working quite the same as way as it used to.
Nope. No, yeah. I mean, there's been a big flip there. We've talked the last couple podcasts, you had the Paramount Skydance, Warner Brothers acquisition, but you had Netflix and, intertwined in there. Definitely we're seeing a big change in the media landscape. Certainly moving away in certain circumstances from some of the traditional studios that have been there.
Yes. Well, and then Chris, the other big news this week, the World Baseball Classic, which I went to back in 2012 when it was in Arizona, in Phoenix, Arizona. Venezuela, country that just President Trump had gone in to arrest the leader of Venezuela, Nicolas Maduro, for drug running and trying to take advantage of the United States for years and years and years. There are tons and tons of fentanyl deaths and everything else. So we go in and take out the Venezuelan leader, and now the President Trump is working with those leaders in a more of a control situation to get Venezuela back to what it used to be. So Venezuela's been struggling for years and years, but their baseball players are the best in the world. They won the World Baseball Classic. So congratulations to Venezuela. You wonder how people can survive in environments like that. The human condition can put up with quite a bit. Venezuela used to be one of the greatest countries in the world as far as economic power, as well as Brazil and some other countries and Argentina. Argentina now is reforming. Maybe Venezuela will as well, but at least their baseball players are doing really well, Chris. Um,
Yep. Yeah. Big win for them.
Big win for them. March Madness is going on this week since last week, and this is down to the last 16 teams, and of course everybody's in on it. And we have a big thing in FourStar. Everybody has a lot of fun with that as well. So that's positive, good news. On the politics and economic front, we're seeing this kind of standoff between the two parties in our legislature, and while the ICE, which is the immigration team, is fully funded for a number of years. They are having a big political football over the Department of Homeland Security, which includes the Coast Guard and TSA. So there's tons of issues with airports now. There are as many as 20 to 30% in some airport where they're having no shows of the TSA guards. So President Trump is bringing the ICE folks that were much maligned in the press because of a couple of deaths of people who were activists who were agitating and creating issues. So they're using the power of government to fight each other. And you know what it's all about, folks? It's all about the election in the fall. We're looking to see if the Democrats can take the election again. They're looking to get advantage and tarnish the president and the party that's in power right now. So, billionaire, richest man in the world, Elon Musk is stepping up and saying he's going to pay for the salaries of those TSA people who are out and we're not getting paid by government. And it is kind of a tough thing for us as a country to ask all these TSA workers to come in when they're not getting paid. And so they're using that pressure against the government. But now Elon Musk is taking some of the pressure off. So this is politics affecting government and affecting people's lives. And it does have an economic effect down the road. It also affects the airlines if they can't fill their planes because people can't get into their airplanes because of security and things like that. So it does. So politics obviously can affect economics, and we're seeing that play out on a very, very big stage. So all you have to do is turn on CNBC or turn on MSNBC or MS Now, they call it, I think, or Fox News or whatever. You see all this playing out. But so Elon Musk is to the rescue, Chris. So there we are.
Interesting enough. I mean, I feel like he's always back and forth. You don't hear about him for a while. He comes to the forefront and swinging back into it now.
There's a fight with Trump, and then they're getting along again, and there's a fight. It's kind of interesting, isn't it?
Yeah.
Um, so after all this, Chris, we talked all about, the oil markets because of the war, all the other political stuff that's going on. Now the markets are selling off. We had a strong market to begin the year, had a strong market last year, and now we're seeing a weak market. Although, as I said earlier, folks, we're still up for the year. However much damage we've seen, the broader markets are still up for the year, as well as the small and mid cap markets have been strong. It's just those certain areas, the big tech, and then of course the precious metals that had a big run. Now they're down and sharp. So we're seeing that play out. But we had enough damage in the market, Chris, in the FourStar program in our protection plan that we've gone to position number 1 of protection. There are 4 positions. Now we're very close to going to position number 2. And the whole point of the protection plan is to ward off big losses in capital when the markets go down. Well, the markets are going up. Everybody does well. Everybody's happy. S&P's up an average of 10% a year. Maybe you can do a little bit better, maybe do a little bit worse. You have some bonds in there, you have a portfolio. But when the markets are going down, people don't ever seem to have a plan. And they just kind of like panic. As I said before earlier in the show, the studies have always shown that investors tend to get excited when the market rallies and they buy near market highs very often. And then when the markets get rough, they don't know what to do. They're in pain because the markets are down and they sell. So you'd probably better sell before the markets go down big. And that's what the protection plan is all about. So we are at position 1, close to position number 2, and we are in protection mode officially right now. We have not been since last year, a week before President Trump's Liberation Day, when he announced all the tariffs, down to maximum protection. That was in 2025. The last time prior to that was we were at maximum protection twice in 2022. And that was the first time we ever did it, twice in 1 year. And then, of course, 2020 and sometimes before that. We've only done it 8 times in 32 years. So the record is about half the time that we go to protection mode, we do not go down to all the way to position 4, and about half the time that we do. So we would love to tell you what we think is going to happen, but we really don't know. But we'll keep watching it. It's an evidence-based driven model. And we'll see if we need to go to maximum protection to ward off a major, major decline. The worst decline in American history was in the 1970s with the oil crisis, when the market was down over 70% from top to bottom between 1973 and 1975. Most market corrections are an average of about 30%. The rough ones are 50% or more, like 2008, like 1987. So hopefully we only see this market pull back a little bit more from here. And we're basically down about 10% from the high. But it feels rough, doesn't it, Chris? This feels like a rough correction because everything that was working so well in the last rally got hit so visibly and so difficult. And of course, the press tries to throw gasoline on the fire and make a big scene and get everybody scared. And that's what we're seeing right now. But we're in protection mode number 1. We hope it doesn't go any further. We're not for bear markets. We're for bull markets. We like bull markets, but we just don't want to lose a lot of money when things get bad. And that's our stance today. So, Chris, what else do we have?
I think that about covers it for this one.
Okay. Well, folks, also look for more information on the Leadership Matrix blog. If you go on to fourstarwealth.com and click on the blogs, the Leadership Matrix always has some interesting articles. We have some articles in there about the oil markets as well, other things that are happening and playing out. So have a look on that. We're planning to do some other interviews. We did a real estate discussion recently. We're probably going to have a discussion more about geopolitical discussions that affect the economy and the markets. So watch for that. And I think that's it for today, Chris.
Yeah, I think that about covers it.
All right, folks. Well, thanks for being with us today in today's Market Explains. That'll do it for us. We'll be back again shortly with another great episode. And hang in there, everybody.
Thanks, everyone. Take care.
Thanks. Bye-bye now.